SMCI Super Microcomputer just released their latest quarterly figures. To be honest, the after hours action was quite something. It first went up 10%, now the stock is down 10%, actually 11% at the time of making this video. It's at now at $547.2. Year to date, the stock was still up 117%, had a market cap of $36 billion, now closer to $33 billion. I mean, this is a company that is trading at a forward PE of 19.2 times, EV to sales 1.6 times. And the analyst expectations, I mean, they're still expecting this company to grow quite a lot year over year, right? I mean, for fiscal 2025, sales $23.4 billion, which, by the way, they guided for way more than that. And that's already a 56.6% increase year over a year that has increased 109% already. So there's definitely momentum with SMCI, with Dell, but the problem here is, of course, how much profits can you actually make? And that's the question, right? I'm here comparing, if you're not watching but listening, I'm comparing SMCI to Dell here, forward PE. That's 19.2 times for SMCI and 11.3 times for Dell. By the way, Dell is also down 4 or 5% right now. They are laying off 12,000 employees or something like that. SMCI EV to EBITDA 14.5 times, Dell 7.6 times. Price to sales, Supermicro 1.6 times, Dell 0.7 times, and then price earnings to growth, SMCI 0.4 and Dell 0.96. So again, it's not that expensive from those valuation metrics. But again, you're buying here a business that, is increasing sales quite a lot. But do they become more profitable? No. If they want to grow more, they'll need more cash. This is exactly what management told us last earnings call. If we want to grow more than 20, 30%, then we will need more cash. Again, if you're looking for sales growth, that's great. But from margins, from profits, not good, because this is basically a race to the bottom. Now, who benefits from all of that? Well, of course, companies like Nvidia, Meta, Microsoft, they definitely benefit from the increased competition in those markets, because that means that they will spend billions and billions, but it probably means that they will pay a bit less. That's how the market works, and that's how it should be working. That does not mean that you should be buying a company like SMCI. Now, of course, it had performed extremely well, but at one point you have to ask yourself, is it still worth it? Can they make money in the future? How? Those are questions you need to answer before buying the company. It can look cheap on paper, but at the end of the day, they need to make money. And as you will see, the evidence shows that, they're not going to make much more money in the future so far. Maybe that will change, remains to be seen. Anyways, before jumping into the report, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we just did the Airbnb video that will be in the top right corner if you missed that. So definitely hit the notification bell so you don't miss future videos. If you want to support me even further, do check out the link down in the description and in the pinned comment. Get the top 10 best stocks to buy now, or go to full.com/couchinvestor. Thank you very much. I'll start with a comment from the CEO. So Supermicro continues to experience record demand of new AI infrastructures, propelling fiscal 2024 revenue up 110% year over year to $14.9 billion, and non-GAAP earnings per share up 87% to $22.09. We are well positioned to become the largest IT infrastructure company, driven by our technology leadership, including rack-scale DLC liquid cooling as business values of our new data center building block solutions. The investments in Malaysia and Silicon Valley expansions will further strengthen our supply chain, security, and economies of scale necessary for the growing AI revolution. And by the way, they also announced a 10-to-1 stock split. So for the quarter, revenue came in at $5.3 billion. That's up 38% quarter over quarter and 143% year over year. But again, like I said, the problem. Gross margin non-GAAP 11.3%. That's down 430 basis points quarter over quarter and 580 basis points year over year. As for earnings per share, non-GAAP $6.25, down 40 cents quarter over quarter, but up $2.74 year over year. As for cash from operations, negative $635 million, up $888 million quarter over quarter, but down $626 million year over year. As for their mix, revenue mix by geography, 61% USA, 10 Europe, 24 Asia, and 5 other. China is less than 1% of total revenue, so whatever China risk there is, they're not affected by it. And so, consensus gurus here again with the great recap. A miss. Revenue miss, gross profit miss, gross margin, operating profit, operating margin, EPS, operating cash flow, all miss for Q4. What did not miss is revenue guide for the next quarter and for the full year, fiscal year 2025. So revenues beat by 18.5% for Q1, but a 1.8% miss for EPS. But fiscal year 2025 revenue, a huge beat, 18.9%. But like I said at the start of this video, that's great and all, but what's the point? Eventually you'll have to make some money, no? Right now, that is clearly not the case. And so this is the picture right now. Quarter after quarter, non-GAAP gross margin comes down. They say your gross margin down quarter over quarter due to customer and product mix and initial production cost on new DLC technology. Non-GAAP operating expenses and margins, so operating expenses goes up, operating margin come down and came down quite drastically. As for the outlook, we've just seen, so in Q1 they expect revenue between $6 to $7 billion, EPS between, GAAP, $5.97 to $7.66, so quite a gap there on the EPS gap. And as for the full year fiscal year 2025 revenue, between $26 to $30 billion. So that's quite an increase, of course, and that definitely means that there still is quite some way to go with regards to AI spending, which is great for the likes of NVIDIA, AMD, and yes, even Intel, which is of course great for the likes of NVIDIA, AMD, Intel, and then all the other big tech companies. And so right now, looking at the graph, to be honest, doesn't look great, right? We are basically in no man's land. I mean, we're back to the lowest point we were at the start of the week, so on Monday, on that Black Monday. But now the question remains, where do we see the rebound? Because like you can see, we are literally in no man's land. This is on the weekly. Even if I shift to the daily right now, it's not like there has been a gap here in the past or something that it needed to be filled and then we're back on our way up. No, we're going to be oversold tomorrow if it stays like this. But other than that, I don't know, we have to see more buyers, of course, than sellers in the coming days to actually really see a solid bottom here. We still have a couple of days during this week, so let's see what happens. Dell is yet to report their earnings. I believe that will be at the end of August or something. Then, of course, NVIDIA as well, August 28th. That's probably going to be a pretty important one. But overall, SMCI, great. Sales growth is better right now. There is definitely more demand, but it's a race to the bottom. I've talked about this since the start of the hype of SMCI, the start of this year. It's a low margin business. It's going to be a low margin business for a long time. So do with that information what you want. If you're going to buy, what's your counter argument? Let me know down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you're not, and I'll see you all in the next one. Bye bye.